is something about being in the room with a lot of our friends, a lot of new faces, and just being able to have those little conversations, put a face with a name, even if it's only 5 minutes here or there. It's incredibly more valuable to make those connections in real life, and I think that's going to become more and more valuable over time.
Welcome to The Derivative by RCM Alternatives. Send it. All right, here with Jason Buck. Jason, haven't seen you in ages. What's it
Well, a
been?
few days.
3 days. Jason was here in Chicago, came in for the conference we're going to talk about. It was a lovely, sunny, it rained right when you got here, and then it was perfect weather for 3 days. You keep joking with your colleague there that you're going to make him come at a non-ideal weather time.
Yeah, our ops guy CJ has only been to Chicago during good weather, so I'm waiting for the next polar vortex, and I'm forcing him to come up there and see you.
It's always good there. What are you talking about? So gonna dive in. We did this for the EQD in Vegas. I've got a lawn blower outside my window, if you can hear that. Um, did this for the EQD in Vegas, which was well received. So I thought we'd try it out with the Return Stacked Symposium, they were calling it. I don't know
Yeah.
why you call it a conference or a symposium. I'm the guy who wears the U2 shirt to the U2 concert, so I'm wearing the Return Stacked swag that I got. So, you want to start with some top level overall thoughts?
Yeah, I'm actually looking at the agenda for the conference, and actually it was the Return Stacking Symposium conference agenda at the CBOE. So it was like they got symposium and conference in there. I think symposium is just a fancier word for conference, but
Love
they
it.
return stack symposium and conference, so they're
And
good to go.
conference.
But is that
Although
the CBOE? Go ahead.
I was just going to, as you mentioned, SIBO, I'll throw in like I had not actually been in the new SIBO yet. And they'd get mad at us. They want to be called CBOE now.
Hmm.
Um, but that place is awesome. I would have lost money on that. I'm like, no one wants to move into the old post office. It's in Chicago where the highway goes under the post office. I'm like, no one wants to move in there, but the retrofit, everything, it's a sweet space.
Yeah, sorry, the CBOE Global Markets was where it was technically held. But like you said, the old
Yes.
post office renovation's awesome, actually. Yeah, the downstairs was just filled with restaurants and everything, and then the views and the windows and everything at the CBOE was pretty spectacular, and it was a nice meeting space. And then not to throw you under the bus, but I was thinking about they have those commercial like kind of vending machine soda fountain things that are always amazing. What do you think the over under if you had one of those? How many Diet Cokes would you drink in a day?
It would be a lot. Yeah, probably be three, maybe three. But yeah,
Three?
it's
I thought we were going double digits.
no,
Ooh, for one.
I try and limit myself to just one. I just went and got a McDonald's one before I got on. Um
I
the
digress. I took us
freestyle
off
machine.
course.
Yeah,
Yeah,
the
yeah, the
freestyle
free.
where you can make your cherry vanilla diet, Coke Zero, whatever you want. Those are great. That's
They also
like
had a
the
freestyle
pinnacle of human
seltzer.
innovation.
Well, I thought the pinnacle was the freestyle seltzer. I haven't seen that where I got to choose all the flavors and have my own seltzer. I got us off topic there. Generally, one, like you said, great location. Two, they did a great job for their first symposium conference, like as putting it together and having great speakers and the entire setup around it, whether it was, food, drinks, etc. And then, it's always hard to pull off a conference like that. I think they had packed house. I think it was almost like standing room only. And so, on to bigger and better, hopefully on the next one. But then I think it's really hard to pull off, when you're having the agenda be return stacking, and to have different speakers talking about return stacking. It's hard not to like beat people over the head about return stacking, but I think they did a good job of letting people kind of free flow, talk about whatever they wanted, even if part of it maybe disagreed a little bit with return stacking, but try to keep it in that general vicinity. And I know, I've been talking to Resolve and Newfound for years about putting a conference like this together. So I was glad to see it finally come to fruition.
Yeah, I wrote down in my notes overall smart people talking to other smart people about smart things, right? It was refreshing to just there wasn't, and I think some people might have thought maybe it was too high, too detailed, but to me it was refreshing. I'm like they dove right into it. We're getting into tracking error and some complex topics right off the bat. But agree, very well done. Corey, you know, you've seen him in person way more than I have. Maybe this is my fifth or sixth time or something, but always taller and bigger and stronger and more handsome than I want him to be. In person, yeah, the Resolve guys are great. It's hard for me. I can't remember them when I first met them, like 6, 7 years ago, if they were all good at presenting and talking at that time. I mean, maybe COVID and being on the Resolve Riffs and stuff has kind of honed their abilities there, but it's odd to have all those partners also be good kind of in front of the stage.
Yeah, I'm trying to think. I think obviously they probably honed their skills being on the mic more, but I want to say, knowing them going back a decade, I want to say they were always had the gift of the gab. They were always pretty good talkers. Maybe, and that was before mic, so maybe it was better off mic than on mic. But no, they were all fantastic as well. And I think that, it's hard also in a conference like that where you have the audience is kind of a bit diversified there, where you have a lot of RIAs, a lot of allocators, a lot of institutional traders, fund of funds, high net worth individuals. You have a little bit of everybody, so it's hard to hit all those pieces to make sure everybody's happy. And I'm sure we'll get into this later, but for me also, it's great to have the speakers and everything, but that's kind of subterfuge for the other conversations that go on during those interstitial moments, right? When you're out in the hallway, grabbing a coffee or you're having lunch, or we had a nice little happy hour at the end, where you get to talk to everybody. And usually the conference speaking maybe gives you a little jumping off point, but otherwise it's really about those one-on-one conversations that you get out in the hallways during events like this for me.
I'll throw out another give prop to CBOE where they had the cocktails and you're standing kind of directly on what I would call Congress Avenue. I think they renamed it something now, but looking east and the Buckingham Fountain is right at the end of that road. It splits into the park there. So the fountain was going up, the lake was there. It was a beautiful day. Anyway, well done, well done. So let's dive in. We'll just kind of go panel by panel here, or session. I don't know exactly what they're calling it, but first one kind of gave us the state, was titled The State of Portable Alpha with Shane McCarthy, who's CFA Global Head of Client and Partner Group at Lab Quantitative Strategies, who I don't know that much about actually myself, but he was great. He had all the data, which I liked. So I have some notes, unless you want to go first.
Yeah, overall, the couple of the notes I had from his talk was, the best things about return stacking or portable alpha or whatever we're going to call it in this. I think we should maybe just agree to call it return stacking or return stack, but we're talking about the old school portable alpha and getting increased diversification and kind of getting rid of the dead cash problem that you have when you diversify. But he talked about, what's great about return stacking is you could be regime agnostic, and then more importantly, you can increase your return per unit of risk. So I think it's going to be a general theme that we had throughout this. Was people are talking about that dirty word leverage a lot of times, but like I think as different ways of saying it is you can increase your return per unit of risk was one of the things that Shane wanted to highlight. But yeah, let's riff off of your notes, and there's a couple other pieces I had to touch on there, but that was the general overview I thought from his opening remarks.
I'll take a step back. That it was interesting to me. For a long time, they've kind of shied away from portable alpha, but they were most guests and return stack guys themselves were talking
Yep.
and calling it portable alpha. So I think worthwhile to just note, right? Return stacking is portable alpha. Kind of the institutional investors call it portable alpha. Return stack guys came up with their own term for it. And then also interesting to note, for a long time, have shied away from talking about leverage. Like in essence, it is leverage. And so, yeah, a lot of these panels were getting right into there and talking about leverage.
We should
Um,
highlight to just for shout out to Rodrigo Gordillo. He is the one that came up with return stacked or return stacking, and I think that's incredibly invaluable because like portable alpha didn't really mean anything to anybody, but like return stacking really grabs a hold of people with a simple phrase, and it thinks about constructing pieces of your portfolio in a much more interesting way than I think portable alpha ever did, where people it's kind of a nebulous term and nobody really knew what it meant.
right. Because alpha, that's, I'm tr looking for returns that have alpha. I'm
Right.
moving them into different places. So means the same thing. But to your point, right? Return stack, I'm just putting it right on top of it. Um, we did a return stack pod earlier this year where we stacked all those guys on top of each other. We'll do a link to that. But back to Shane, right? He had all these stats, which I loved. He was showing, basically that the concept has become more and more accepted. in the industry, he had he had some stats on different endowments and institutional money. The bigger funds do this a lot more. But big takeaway for me that in his data there, that's no longer niche. It's gaining serious traction amongst the pensions, endowments, foundations, etc. He used the old real estate analogy, right? Of like people get nervous about leverage and return stacking or portable alpha, but real estate, no one has a problem putting down 20% to own this whole thing. In theory, that's a similar thing. And then I wanted to get your thoughts. He mentioned, and this was throughout the day, he mentioned a lot of these groups are having more tolerance for tracking error. And he actually had a graph that had it said alpha slash tracking error, which was interesting to me if they're equating the two things as right. If I guess if you are above your index, that's alpha, but that is also tracking error, positive tracking error. So
Right.
anyway, were you triggered when you heard tracking error, or what's your
Yeah.
thoughts on it?
Anyway, I think outside of leverage, probably the second most term or talked about was probably tracking error throughout the symposium. But I want to go back to what you said though too about he had some great charts on the usage of portable alpha or return stacking on with high net worth individuals, family offices, institutions, pensions, endowments, and I want to say most of them had in that 40% range. And I was a little dubious of that. I think it's really catching on more and more, and it's coming back after some issues they had with portable alpha that was basically stacking equity like returns on equity like returns going into 2008, which gave it a bad name. But I think that the institutional adoption is there, but it's a lot smaller, and maybe that percentage is hiding the magnitude, like where maybe people are 100% allocated to stocks and bonds, and maybe they're tacking on and maybe another 5 to 10% to alternatives. So it'd mean they're using portable alpha or return stacking, but maybe they're only using it in small amounts. So I just thought that 40% seemed like a really large number or percentage to me that people were using it, given how much we try to talk to people about it and the lack of usage we kind of see across the board. And then obviously we're in a room where people are very interested in the topic, so it's a lot of echo chamber there. And then going to tracking error, like you said, it's interesting. Even if you stacked a bunch of betas on top of each other, and that's the way you use return stacking, what are you using for your benchmark, right? We work a lot on this, and it's difficult if you have global stocks and global bonds. If you're targeting different durations than you would like an AG or a VBank 60/40. I think using any sort of benchmark is really difficult when you're doing return stacking, and you can show it in the best way you can. But like you said, it's gonna vary, and people are using anywhere upwards plus or minus 300 bips over quarterly or annual kind of time horizons. But once again, it's like, is that your benchmark and is that alpha? That's debatable, right? You're just stacking up betas, and your portfolio is going to vary a little bit over even your benchmark betas, especially when you're using a bit of rebalancing premia that I'm sure we'll maybe get to in some of the other topics of discussion.
Yeah, and I think he said there's amongst the polling or however he's getting this data, there's been more tolerance for tracking error. So which also tells me if people are like willing to take on a little more risk, they're willing to look for different alphas and put those in their portfolio. And then I think he was the first to mention, of course, because he went first. But he put a cost to it, right? Of which we don't necessarily talk about all the time, but there were some audience questions around it, and he's saying, yeah, the cost of stacking is basically SOFR plus 65 bips. So he put a cost on that, and then throughout the day, we heard other people be like, yeah, that's the bogey. That's what you have to get over. Your alpha has to be outperforming that SOFR plus 65 in order for this whole concept to make sense.
Right, that's your financing cost when you're adding leverage, right? And so that's what, yeah, like you said, top conversation throughout the day is that's your hurdle rate or your bogey if you are going to stack these things on top of. But also easier said than done. There's going to be times maybe when your a strategy is underperforming SOFR, right? Over short time horizons. So I think that was a bit easier said than done.
Segment two was Jonathan Glidden, I believe is how you say his name,
Yep.
CIO of Delta Pension. So he was introduced as I wrote down here, there's a CIO Hall of Fame question mark. So Rodrigo was introducing him and gave all his accolades and mentioned that he's in the CIO Hall of Fame, which congrats, but I didn't know there was a CIO Hall of Fame. But my takeaway, he was even as he spent about 5 minutes talking, I'm like, this is the best speaker of the day. And no offense to the other guys, but he was just polished. He's done it. I'm sure he's been in front of 1,000 boards and somewhat had the biggest job there, right? Running this huge pension. Um, and had brought, we'll put in the show notes some of the articles and whatnot to what he's done at the Delta pension, but basically brought it out of the dark ages, seriously underfunded. I think the one chart he showed had the liabilities of the whole pension were greater than the market cap of the company, which I
Yep.
wrote down like bankrupt question mark. But brought that all the way back using portable alpha. Um, but I'll leave it there and get your thoughts on Jonathan before we dig into it.
Sure. I knew Jonathan was actually going to be good because about a year or so ago, the Return Stacked guys did a podcast with him that I thought was really enjoyable. And like you said, he's a great speaker, and really compelling. So I knew that it was going to be one of the good ones. It did remind me, like you said, he has to be such a great speaker and compelling speaker and a clear thinker and speaker because he is dealing with a board of directors for that pension plan. And so it reminded me going back to even the earlier one. That I think it's really difficult for human beings to not have that benchmark, right? So even if you're talking to board of directors, they want to see a benchmark to see if you're over or underperforming, right? But like
Mm.
over what time horizon? And so that's why, if you're Jonathan at Delta, you have to be really good at communicating to your board of directors, especially when you're underperforming. And then, like you said, they should be asking you the questions when you're quote unquote overperforming, right? Because that is tracking her to the
Yeah.
upside. But I think that's what makes these decisions really difficult for people in general is one, a lot of these pensions have boards they have to talk to or endowments. But even two, even if you're doing it individually, your neighbors are going to be, going cruising along with 60/40, and you're going to over or underperform over, months, quarters, even years. And it's just really hard for us to not deal with some sort of heuristic benchmark. But when you're doing this, the question is, what's your benchmark other than, maintaining your purchase power parity, outpacing inflation, reducing volatility and drawdowns. That way your money's there when you need it most. Those kinds of things they're not quote unquote benchmarks for that, people for understandable reasons default to.
Love it. He had a great little heuristic. I'll
Yeah,
wonder
go
what
for
your
it. If
thoughts
you're going to list
are.
it. Yeah.
Yeah, on the back end, what your thoughts, whether this is a fourth pillar
Yeah.
of their, but he basically said there's four ideas that have been groundbreaking in the investment world in the last 30, 40 years. The first of which was out of Chicago here, University of Chicago. Markowitz, all that. Volatility equals risk. We've done tons of podcasts debating that, which is it can and does sometimes, but not always. The second gave a little backstory on Jack Bogle, low cost indexing. Uh, Likely, probably agree there. Third, which definitely agree with, was Yale, David Swanson, getting into privates, sort of that private equity illiquidity premium, which is now switched because everyone followed the model. And then fourth, portable alpha, which I wrote down here. Oh, they were going to call it Rodrigo's folly, Rod's folly.
Yeah.
Um, but he was putting portable alpha in this concept as the fourth kind of groundbreaking thing that's happened to the investment industry. Thoughts, comments?
Yeah, I didn't have a problem with this choosing those four. I mean, obviously, I'm a huge fan of Harry Brown and permanent portfolio, so maybe it would have been a fifth in there or whatever. But kind of the fourth one is he's saying, and he gave credit to Bridgewater on that with like their risk parity is leveraging the variance for more uncorrelated assets. So the idea of increasing uncorrelated asset streams, but then lining them up with their variance to try to maybe, in that case, it'd be leveraging the bond part of the portfolio to match the variance of stocks. But what he said with that, the new revolution is leverage for greater portfolio Sharpe ratios. And even the quote was, there is a thing called good leverage. So once again, this is tying back into our theme. We're going to be talking a lot about leverage or tracking errors. And so, just highlighting there's a good thing called leverage. And he convinced his board of that. And then he was talking about Sharpe ratios, which I think people forget is they tend to look at Sharpe ratios on individual strategies when the whole point of Sharpe ratios is on the portfolio effects. So that's what's more interesting is if you combine, low Sharpe ratio individual strategies, you may get a higher Sharpe ratio as long as you're getting uncorrelated assets and you're getting a little bit of that rebalancing from them. So I just thought that was another thing to point out is once again, I think people misuse Sharpe ratios all the time. And Sharpe ratios was much more of on that, efficient frontier or your total portfolio and how well that was doing, especially if you had uncorrelated or negatively correlated asset classes.
And then for him, he was breaking it down into more real numbers. They use 40 different hedge funds. So really going, I wanted to say hog wild, but it's probably not the right frame.
Yeah.
But really going smartly into, hey, if you're going to do this, do it as mostly diversified as you can, and then adding leverage of 40%. I took a little offense. He had one chart where his hedge funds were in physical assets, which did make sense. And then I wrote in big letters here, duh, that he basically brought to them of like, hey guys, when people have money, when the economy's doing well, what do? They fly around the world and the country and earnings are good. When people start to lose jobs and the economy's not doing well, what do they cut back on? Flights. So basically, he came in and taught them, hey, we need to be diversified. We need to have things that are non-correlated to the economy because that's when we actually do well. So we don't need to be doubled up on the economy, which is music to your ears, I'm sure. Um,
There's other things in that though with the leverage too. I think there's a lot of hidden leverage that people don't realize, right? If you're just investing in S&P 500 index, those companies that are within that index are going to use debt and financing, so they're using leverage inside those systems. These days, private equity or private credit are really hot, or venture capital. Those are just different forms of leverage where you're leveraging up equity or debt. So I think there's a lot of other leverage built in there. Like there's a couple slides in there I took umbrage where people were saying this is their level of a leverage on there when I think it's much higher. And basically they're able
mhm.
to, maybe this will be part of the other discussions, hide it in swaps, et cetera. Or adding more private equity into the book. So you're able to kind of get some pseudo leverage, so to speak, in there. And so, the key ways that were talked about throughout the day, I'm sure we'll touch on, is like you can use managed futures and use that performance bond you get in managed futures to have more capital efficiency, sometimes referred to as leverage. Or you can use swaps with banks and counterparties too, and that's what some of the bigger institutions. Once you're at hundreds of billions of dollars, you're allowed to negotiate with banks for getting swaps on products you want, so you can get even quote unquote cheaper leverage, but you're still going to play SOFR plus. You're just maybe hopefully going to pay SOFR plus bips instead of SOFR plus points.
Yeah. Which he actually said it was 40 bits per month. So it's still right around the T-bill rate, right?
Yeah. Yep.
Um, Two quick stories. I loved his story. He had just started, was it there or I think it was his previous place. He was at Emory University. Um,
Hmm.
and they basically were like, hey, everyone's donated their Coca-Cola stock. Our whole endowment is
Yeah.
basically Coca-Cola stock. And so he was new there and they were like, okay, go sell $3 billion worth of Coca-Cola, which was just a crazy story. Um, I should have asked him afterwards how he did that. And then the other funny part to me, which I actually talked to him for a minute afterwards, and I'm going to hopefully get him on the pod. We talked about that, but we'll put a link to this blog post we wrote. But at the same time, mostly that he was doing all this, they had someone in charge of their fuel hedging cost that was just trading oil futures like crazy, like made billions of dollars and lost billions of dollars. So it's kind of a commentary on like, even though this side of it, and I'm jumping a little bit all over the place, but the also interesting that twice we heard from pensions that fund them and then they're out of it. The company's like, I'm done with that. I put up all the money I needed to for that, and now it's on your guys' hands to keep funding that. So I don't know if there was a
And
question or a comment in there, but
And
go
no,
ahead.
yeah. No, I know you wanted to point out that maybe that was before his time there, but also if you put the article in there, that was fascinating to me about the article is that he kept going to the board and he's like, yeah, I have positive carry on all our hedges on oil. And it's like nobody raised their hand and be like, wait, why do we have positive carry on our
Yeah,
insurance? That
yeah,
should have been
no,
the first clue. Like, yeah, it was something like they were making like $50 million a year on their insurance on the oil hedging.
what could go wrong? Um, and then he said, I think that was during the Q&A, a lot of the questions in Q&A and throughout were basically the human element. How did you
Hmm.
get this put through your board, which kind
Right.
of resonated with the RA audience and individual invest. How do I get this? How do I convince my client to do this? How do I convince, as the client, how do I convince my RA that this is what I want to do? And there wasn't really a silver bullet answer there. It was just like, hey, you got to somewhat dumb it down, explain it in simple terms, use a mortgage example or something like that. And like, hey, all leverage isn't bad. Here's why I think this leverage is good.
Yeah, I think we're throughout the day, we've talked about this a lot before. It's like everybody's trying to use like different metaphors and different ways of talking about what these systems entail and trying to help people understand and make their brain clicks in different ways. But as you know, I kind of feel about it is like, I'm not sure you can convince anybody of this and in general, right? Like they either
Yeah.
have to have gotten burned in some way, shape, or fashion, and they realize, they're trying to stay rich with a return stack portfolio and they're trying to actually get proper uncorrelated or negatively correlated diversification into their portfolio and actually, increase their Sharpe and hopefully reduce their drawdowns. And like until somebody's fully convinced of that, I think convincing them out of whole cloth is incredibly difficult. So I really feel for Jonathan and at Delta, or we were also talking to Roxton later when he was at UPS, or other people that are at in at an endowment or pension where they have to convince a board of these things. I think is just incredibly difficult, and we just try to send out our bat signal and just look for like-minded people that have been searching for something like ours. Because I'm not gonna go up and when we're out in Chicago and stop people on the street and convince them that they should
Yeah.
broadly diversify, right?
Hey, do you like cockroaches? Come over here.
Yeah.
Um, a few other notes I had here. One, he admitted he's like, oh, you RAs have a super harder job. He's like, I have one client, the
Right.
pension. Yes, I had to go in front of this whole board and everything, but I have one client, one set of assets and returns. You have who knows how many clients, each have a different profile and everything, so it's a much harder job. And then he had a great quote, alpha makes everything better. So it's like as you're doing this, as he was selling it to the board, they were having success. The hedge funds were
Right.
providing alpha, and he's like, "Hey, that made my conversation much easier."
Yeah,
Um,
returns make everything easier, don't they?
yeah. And then how is my joke at the I asked a question slash joke after his talk. Do you remember
I can't remember your dad joke on that one. It might have been the bathroom. Remind me what that one
it?
was.
No, he was talking about how he saved this whole pension. I said, "Hey, can you quit and come to
Hey,
Chicago and fix our problems?"
exactly.
Which depressingly is like, I don't think there's any fixing that. Any other thoughts on Mr. Glidden?
No, I like you said, I really enjoyed if you can put in the show notes, the podcast that Return Stack did with him is excellent. And then it reminded me of a paper they wrote with him or a little essay that we're actually going to put into our newsletter this month as well. Because I think it's great the way he talks about it. But once again, even with those, that's like it's really about to get these hear people tell the stories in person. It's the Q&A after where you get the more unique questions than people speaking their book for an hour, and then catching up with them in the hallway to add those follow-up questions or get into some of the details that you always want answered.
All right, moving on. Panel three was Patrick Kazley, Head of Solutions, One River Asset Management, talking convex overlays, enhancing compounding through diversification. So this is right up your wheelhouse, right? Talking volatility traders and trend to be the first and second responders. He had his, which I've heard him say before, sumo wrestler analogy, which you could talk to a little bit. I loved his four types of down move chart, which was great. A sharp, like a March 2020, moves down
Hmm.
really quickly, bottoms out. Let's call it 2022, just a long, slow grind lower, V-shaped recovery, kind of a gamma. And then he had what works well in each of those, which was some of its long volatility, some of its trend, and some of its gamma traders, which gets a little into the weeds. But I'll leave it there and hear some of your thoughts.
Yeah, I think, we talked about these metaphors and analogies that help people understand. And so typically throughout our industry, especially on the long vol side or tail risk side, that's harder for people to understand is, as soon as any of us come up with a metaphor analogy that works, all the rest of us tend to copy it. And
Yeah,
because if it works, it works. And so he even started, I think, bringing up David Dredge's analogy of an F1 race car. It's not the car that can go fastest in the straights. It's the car that has the best braking in the turns that then can accelerate into the straights faster, which David has done a great job over the years bringing out. And then the other one you referenced is first responders, second responders. I think, One River does a great job of riffing off of that, but that comes from Makita and my buddy Jason Josephiak when he was kind of building those risk mitigation strategy essays that Makita put out. But the idea is you need, first responders and second responders. And the idea around that is that if you had some sort of liquidity cascade, as Corey Hostein's trademarked, like March 2020, when you have a very acute event, whether that's endogenous or exogenous, you really need those like long volatility and tail risk strategies that provide that negative correlation for those shocks when markets shock down, because everything else in your portfolio can get sold off. Everybody's throwing out the baby with the bathwater. Even things like gold, et cetera, get sold off because everybody's going to cash. So if you have that structural negative correlation that you get from like tail risk puts, is like you're a liquidity provider into that market. So you've been inventorying all those tail risk puts during the good times, and then as soon as it hits risk off, you're the one selling that market when everybody needs to pay more to hedge their book. So that's your kind of first responders in those acute stress points. And then your second responders are when you have like stronger or lower grind down environments, where that can be like 2008 or 2022. Typically, you have strategies like commodity trend following, et cetera, that tend to do better in those, and that's why they're called second responders. And then you could argue historically, where do long bonds or just the treasury markets in general fit in there, especially if the knee-jerk response is to cut rates. You can get a nice ballast from there too. So you get into other and then we can get into within those first responders, second responders, use delta, gamma, vega strategies, et cetera, and just thinking about the layering of those. But like you said, I think the interesting riff was just kind of showing the four shapes of those as well, just besides like sharp and acute versus long and drawn down, right? It's like, do we have V-shaped recoveries, K-shaped recoveries, all those sorts of things? Do we just kind of L shape, flat and long periods? But I'll let you jump in here and save me.
Save me. Um, he also added a new moniker, fast twitch and slow twitch
Oh, I
muscles.
like that one. Yeah, that was a
Yeah,
good one.
so that was good. Volatility's your fast twitch, trends your slow twitch. I think he was the first one, and really kind of only throughout the day, who actually went practical of like, right, the other guys are just adding alpha, adding hedge funds. Like, okay, which ones? Like,
Right.
what's my goal? If your goal is non-correlated and get a longer compound growth, he was kind of getting heavy into that. And then also one of the only ones is like, it doesn't necessarily need a positive expected return. It doesn't need a positive sharp if it's basically vol, if it pops at the right time. So he had a lot of cool charts, a lot of cool back testing. I think he was the one who ran like a hit a button and it was the charts were moving in real time, right?
Yeah, yeah.
Which is always cool. Like we're such at the end of the day, we're just primates, right? Like, ooh,
Yeah.
moving chart.
Actually,
Classic.
one of my things, I leaned over to CJ and I was like, we need to use that app that does the moving charts for us. Cause like, yeah, you can overlay those into your charts and it does that. Yeah. And what he's really showing is the rebalancing effects, right? And, Corey's talked a lot about rebalancing timing. Look, the hard part, obviously, with you and I talking about this is like, we agree with almost 99.9% of what was said on stage. So, and it also feels like we're talking our own book. But yeah, the rebalancing effects, especially with negative correlated strategies, like in March 2020, the market sells off. If you're able to monetize those tail risk puts, and then if you have a system for rebalancing, you're rebalancing to buy those stocks at that lower NAV point, and that really affects your compounding over time. And this is the things we talk about with ergodicity in a non-ergodic environment. Of how do you compound your wealth effectively and efficiently over time. There was some questions. I need to go back, and I haven't had time yet. They have a paper called the Convexity Rebalancing Act that talks a lot about this. Maybe we can put that in the show notes. I haven't had spent a lot of time on it, but he was saying, they were looking at calendar rebalancing versus threshold rebalancing. And so, for example, in Harry Brown's permanent portfolios, it was a quarter each stocks, bonds, gold, and cash. And instead of having like a monthly, quarterly, annual rebalancing, he suggested that use thresholds. So anytime they got 10% out of that threshold, so if that 25% went up to 35 or went down to 15, you would rebalance across the portfolio, which happened like once every 1.4 years, I think, over the last like 40 years. So that's threshold rebalancing. And a lot of times people like that because then you're not rebalancing too much just based on a arbitrary calendar. But they were talking about how monthly rebalancing worked much better than threshold rebalancing. And they said that the threshold rebalancing had twice the variance. So I really need to read through that paper just to make sure all the parameters are in there. Because Roxton and I were talking a little bit about after, and we both were a little dubious of that. So really need to dive into that paper. So especially if we can put in the show notes, that would be a good one to look at. And then, as you know, like I should be somebody that loves monthly rebalancing as we're forced to do that as a function of monthly liquidity. But like even I was kind of dubious that was the right
Hmm.
solution. But whatever it is, I mean, any sort of system for rebalancing helps, and you get that rebalancing premium from having negatively correlated assets to hopefully help you compound better throughout time.
Yeah, I had written down here big rebalance debate, which I don't remember there was a
Maybe
big
that was
debate,
it.
but maybe that was between us.
Yeah.
Um, and then good chart on rebalance timing. So yeah, that was great. And then he also had a unique, which I want to get, maybe I'll get his presentation. He had a unique way of looking at correlations amongst all the different asset classes, where he reversed them down to zero, I think is what he was saying. Like if you took all these back to
Hmm.
zero, which would basically take away all their outlier returns, what did the result? And they all look pretty similar, which is kind of similar to some of Med Faber's work of like, hey, over the long term, these things all have a sharp around X, and they all kind of tend to do the same thing. It just has these different peaks and valleys, which is what you're looking for in portable alpha, different peaks and valleys. But yeah,
Yeah,
overall, he had the best charts by far.
I'm just trying not to take a victory lap because these are the things I've been arguing with you for a better part of a decade. So it was good to see some of those stuff. But then again, that's confirmation bias. So we'll throw out my argument on that side.
And Patrick is a good guy. Talking with him after, they were all good guys. They
Well,
were
yeah,
all
I'm always been a
guys,
fan. Yeah, well,
unfortunately. But yeah,
unfortunately, I'm a big fan of One River. They do stuff very similar to what we do. They've been around forever, much bigger institution, but they've been in the ball and the trend space for like the history of the firm. So really always like listening to anything they have to say or Eric Peters has to say. It's always great. But to your point, yeah, we need to up the female quotient on the next return stacking symposium.
definitely. Although right around this next panel, they started to show up a couple, handful.
Yeah.
The next panel was portable alpha for the quote unquote taxable masses. So basically getting it off the institutional more towards I'm a RIA. How do I get this in my clients' books? Um, this was the unfortunately named for the financial business, Michael Crook, CIO of Mill Capital Advisors. But also it got me thinking, like, how good does this guy got to be where his name's
Right.
Crook and he can still raise money and manage money? Um, but and I wrote this in the beginning as he started talking, I wrote refreshing, less technical, right? He was kind of talking about how
Mm.
you deal with clients and talk, but towards the end there were tons of charts and numbers and stuff. So, but at the beginning it was refreshing, it was less technical. And then there was at one point a math formula on the screen, and I'm like, wanted to send out a PSA. Nobody ever put math formulas on in a slide deck. Um, so I'll stop there. Your thoughts?
But yeah, it just threw me for a loop there because it reminds me of one of my other things I'm always talking to hedge fund managers about is there's a great book on Steve Jobs' presentation philosophy. And one of them's like all pictures, like no words, or if you, it's just the fewest words possible, or in really big font. And I'm sure you and I have the same issue. Is like we were in the back of the room. A lot of those slides are unreadable for the audience because everybody wants to put like multiple charts and lots of words on it, same as they like to do in their pitch decks for hedge funds. But they got to get better at being more visual and doing the slide charts for the back of the room. So that was
Yeah.
just a side note there. That you made.
And then
I'm trying to think. Go
I'll
ahead.
give you some insights. So he was talking, he was bringing it back to practical things, right? So in a taxable account, you maybe want to use munis versus treasuries.
Right.
He was talking expense ratios. He was talking, which I actually wrote down because I'm not as familiar with this as the RA space, 90/60 equity
Hmm.
replacement strategies. He's saying those are great, but he started getting into clients will fire you in the drawdown. And this came up later too, of like, they
Yep.
just want quarter over quarter consistency. So even if 90/60 looks better from a math standpoint, if the client can't live through it, if the path doesn't work for them, they're not gonna stick with it. And then he was basically saying the hurdle isn't that bad, which was basically just cash plus 30 bips, which is right around what everyone else has been saying.
Well, yeah, that was my question for you because unfortunately during this I got pulled out into the hall a few times, but that was my general takeaway. Is like I was hoping for maybe a reading about portable alpha for the taxable masses. I thought there was going to be some interesting techniques. I didn't know if we were going to get into like AQR, tax loss harvesting, those sorts of things that have gotten really
Yeah.
popular these days. So I was hoping there was something we were missing on the taxable side, but no, it's more about like you said, it came down to similar to leverage, right? It was like cash plus 30, 40 bips. It was definitely sub 100 bips. Which was your quote unquote tax alpha. So that was refreshing to hear, but it also, like you said, it boils down to how you're stacking those within a taxable account to make sure you get the best taxable efficiency out of it, which is, I wouldn't say easy to do, fairly trivial to do with like the return stack products, right? In thinking about the individual clients from an RIA perspective, that's why they have those building blocks in there so you can adjust based on somebody's tax exposure or tax profile.
And then he had a great line, a triple underline. outsource the leverage, right? Which I hadn't heard before. That was a great one. Of like, you don't want to like ask your clients to do this. You want to, you're outsourcing the leverage. This does it for you. You don't have to
Mm.
stress about it. And then he had another good thought right towards the end. It might have been in response to a question about private assets, basically saying a lot of RIAs are getting pitched on private credit and private equity right now, but it might be 10 years too late, right?
Yeah,
If
the
that's the
exit liquidity.
last, that's the last alternative battle, and maybe these liquid return stacking alternatives are more flexible liquid choice that you can have the same sort of non-correlated stuff, but in a more liquid format.
Yeah, maybe for those who haven't read it, he'll probably be at the next Return Stacked Symposium is Dan Rasmussen of Verdad. He's written a lot about PE. I mean, he started his career at Bain, but like he talks about in the heyday, the 80s, 90s, and maybe early 2000s, they were buying companies for a multiple of 2 to 3x, and then they're putting maybe 2 to 4 turns of leverage on it, and all of those have gone up 3 to 4 times. So that's why it takes decades for those returns to really manifest, and that's why people are performance chasing in those. But maybe those are disappearing at this level of multiple and this level of leverage. And then as we're saying, people aren't getting their DPI these days. But I'm not going to be the one to say today is the death of PE because it could probably run along a lot longer than I can, imagine it would.
And to me, that news last week or 2 weeks ago, EA Sports got taken
Yep.
private by PE. Like
Yep.
that's before they die, they'll start using that playbook, right? Like there's too
Well, it's
many,
just, yeah, it's all extend and pretend and yeah, continuation funds, except they have so many tools in their toolkit to just keep
yeah, they'll
keep
just,
the train going. Yeah.
but to me, it's not even extend and pretend. Sure, maybe there's now they'll switch. Like, hey, there's more value in public equity than
Right.
there is in private because we kind of bastardized the private side. So let's go into public equities that are, and who knows, maybe they can run the same playbook, but super interesting. And then I got to shadow some of the charts that Michael had were rightfully so, and which I think was good overall. People were talking about risk, they were showing drawdowns, they were showing this, but some of them were super sharp downturns that he was showing, which were making some of our friends in the back of the room a little nervous as they were like, why is this chart pointing straight down up on the screen?
Mm. Look like the fart coin chart in the last week.
Yeah. Next panel was Dylan Pierce from the Return Stack was hosting, talking to a, what do we call it? A gaggle of advisors.
Panel of advisors.
4 different advisors. Brandon Arns, portfolio manager at WJ Interests, which I think is a good name instead of capital or wealth or all this stuff.
Yep.
Homer Smith, he's been on the pod. We'll put a link back to that. Owns Convergent Wealth Partners. Rich Toscano, an advisor with Pacific Capital Associates, and Sanu Vargas. Don't quote me on that. Vice President, Global Macro Strategist at Carson Wealth. So this was kind of designed, hey, these guys are actually putting this in practice, using it out in the field. Let's get their thoughts, which I thought went quite well. Super practical. Any immediate thoughts from you before I go through my notes?
Yeah, you skipped over lunch break, which is always the favorite
All
part of my
right.
day because like to
Yes.
have those side conversations. It goes back to I really wish I could think of that Steve Jobs books on presentations, but it's a very simple title. But that was one hack I'll throw out there. The other hack I'll throw out there is when you have lunch with like 100 people. If they ask any dietary preferences before, even if you don't have any, and it's annoying to have some, maybe throw one in there because then your lunch gets set aside and people may take a little more care in making it. So of course I did that, but I think it backfired on me. I think I ended up getting the veggie sandwich then because of that. But
What'd you
always,
say your restriction was?
I think it was
Just that
just
I want someone
dairy.
to pay attention to me.
Yeah, I just want somebody to pay attention. It's like the green M&M theory, right? That's all I'm
No.
doing. And then those were set aside, so it was easy to find mine.
But it was
Um,
also weird that it was like your name in big letters
yeah.
on the box. I wanted to take it just so you're like, wait, where am I
Just
going?
yeah.
Just to
And
mention
then
it.
during lunch, I got to talk to the buddy Jim Carroll from Vixologist on Twitter X. Probably the nicest person in vol space. So it was great to talk to Jim. It's so funny. We've always tried to link up whenever I'm in Charleston area in South Carolina and end up running into him in Chicago. So hopefully I'll see him also
Yeah.
next month in Charleston as well. But had a great conversation with Jim during lunch. Just a reminder, like that's the best part of these events is more of those personal connections and those side conversations that you get in during those interstitial moments. So going back to the panel of advisors in the field of return stacking and practice. One, it was obviously, one of the things Homer kept pointing out was really the psychological effects of this or the sales side of it, not so much the portfolio construction. And what they've been focused on at Convergent that he's been focused on lately is also like saving clients that are selling their business on inheritance taxes, et cetera. And the amount of alpha you can get there as an advisor versus maybe the portfolio construction are two completely different things. And that's the real value add. I think that a lot of advisors can think about is more the estate planning side than the portfolio side. Because as long as you're getting broadly diversified portfolios, as Meb has shown a million times, you're going to get in relative bands of returns, but you can really make that difference on doing their estate and tax planning. But one of the other things that Homer pointed out that you pointed out earlier is a lot of times when you have a lot of diverse client base as an RIA, you may buy into like this return stack concept, but to get each one of those individuals to buy in is incredibly difficult. And we've seen this in practice a million times. But one of the things Homer pointed out was in 2022, it was great with clients for that quote unquote outperformance over like a benchmark 60/40. But then since 2022, it's like, what have you done for me lately? Right. So if they've trailed it all in 2023 and 2024, 2025, that makes it incredibly difficult to talk to clients because they conveniently or quickly forget how they were saved in 2022 by having these diversified, uncorrelated, or negatively correlated portfolios.
There was a good point I'm forgetting. I didn't write down, unfortunately, who exactly said it. But they were talking for a second about like, hey, even before you get to return stacking, there's return stacking like things you can do in your portfolio. So we've said, first of all, if you have a choice between a 5 vol and a 10 vol program, right? If like you're looking at two managed futures programs, one's 5 vol, one's 10 vol, choose the 10 vol. Like you're getting free quote unquote leverage there, free volatility. And that's easy stacking. You just choose that, which we're gonna have 700 links in the show notes. The Dunn just did an interesting paper of basically like why you want high vol trend. So it's kind
Yeah.
of along these lines of like just saying I'm gonna stack something, it doesn't necessarily in a vacuum doesn't make sense. The more volatility you have, the less capital you have to put to that, and the more you can use that cash elsewhere and stack it.
Well, I can't remember if you talked about privately or you asked on the mic, but this is a thing we've been talking about a long time, even with institutional allocators, is that if I can give you the same program and it's a 10 ball or 20 ball or a 5 ball and a 10 ball, you're going to pay less fees per unit of risk. And it's amazing how women don't care, right? Because it's more like this CYA effect if everybody wanted low vol. We've seen in the last decade plus that everything's moved to sub 10 vol because that's what the institutional allocators prefer. Whereas, when you're coming up and we love our market wizards, in the 70s and 80s, they were running 40 to 80 vol, and
Yeah.
you can attenuate your allocation size accordingly, which you were saying is like, so you get better bang for your buck for lack of a better term, and you get better usage of your fees, and then you get better capital efficiency. And I think besides even what Dunn wrote about that, I think there was some great pieces more recently by Cliff Asness on AQR. Go ahead, throw that in the show notes as well. Is
Yeah.
it's just I'm just going to reference everything now, so the show notes will be longer than the show. But Cliff talked about too is like not only do you want that high volt, you also want it in his reference is in a commingled fund, right? Because you have all those protections as an LP in a commingled fund, especially if you're dealing with managed futures at high vol, where if somehow they were to go into some sort of debit, you're not responsible for that. So I think that's just another layer of protection that people don't think about. Is like if you can be in a high vol commingled uncorrelated strategy, it has enormous multiple layers of value to you as a portfolio construction tool.
And then again, a lot of this panel was spent, which doesn't necessarily apply to maybe our listeners, but how do you sell this to your board, to your client, to your RA, to your wife? I don't know who you're selling it to, your husband, um, who you're selling it to. But a lot of that just comes back to, right, I would just take it like ignore how do you sell it to yourself? Like how do you
Yeah.
mentally, they had a bunch of, what was the guy's example of like thinking about leverage when you're riding a bike in your cul-de-sac versus if you're riding it on the freeway, you're like doing the same thing, but two very different risk profiles. And he's like,
Yeah,
I didn't quite put it together which one's the leverage. Um,
but there's a weird dichotomy though too of like I think the simple way to think about it is the get rich portfolio versus the stay rich portfolio. And
Mm.
unfortunately, we've always maybe thought about 60-40 or stocks as maybe the stay rich, where in the
More the
last 10,
get
20
rich.
years, that's really been the get rich portfolio. So now if you want to stay rich and, we have an idea, times when, inflations picks up or stock bond correlations go up, all of those things matter. But maybe that's kind of the divergent part of selling or pitching it is that people that are pitching it are, trying to convince their clients to stay rich when their clients still want to get even richer. And so maybe that's part of the process too that makes it so incredibly difficult to really sell these programs, to try to get your client just to, to admit they've been incredibly fortunate and now maybe it's time to shift tact a little bit, maybe do a 180 and try to stay rich.
The next one was requested that he who shall not be named, like Voldemort. But he requested that he was not named, so we'll just call him a nice gentleman from a large pension, one of the largest in the world, top 10. Um, so a few, my first interesting thing was he started out with a story, which it feels like I've heard this story on dozens of podcasts of someone goes into a big pension or a big prop firm or somewhere, and almost immediately, as a young person, is given some bucket of money to trade and loses it. So part of me is like, oh, great, you got training on the job. But part of me is like, what do these, do the pensioners, do the people, the stakeholders know that their money's just getting thrown around? And are the people in charge of that asleep at the wheel, or is it part of their brilliance of like, hey, I can hone these people with real world experience with what's a rounding error on our hundreds of billions of dollars? I don't
I
know if
think that
that's
you say it's more of that advancement of paper trading into a rounding error, because that's what I was going to bring up more than anything is like when I talk to some of these pensions or endowments, as soon as you get over like $100 billion, you're beta. You just have to accept it. Right. And so a lot of them will talk about their active strategies, but those are on the periphery. I mean, some of the people there, we're talking upwards of almost $1 trillion. So the idea that you're going to have active strategies and you're not going to be passive beta, which essentially is like Norges Bank, the Norwegian Sovereign Wealth Fund, it's like just accepting that. Because your active strategies in maybe less liquid markets obviously are going to be severely capacity constrained. So you're talking a matter of bips around the fringes. Does that really help at that level? And then even when they call me up to talk about volatility or tail risk strategies at those sizes, once again, it's incredibly difficult to hedge that. You can't do that in necessarily listed markets. So now you're going to have counterparty risk. Are they going to pay you out appropriately? Can you swap it? Like do a cash
yeah.
sweep on a daily basis? There's so many inherent problems of once you get over 100 billion that when you're getting closer to a trillion, like it just accept it. You're beta. It's fine. And maybe you can, yeah, stack some betas, but even getting leverage is going to be incredibly difficult because who's the counterparty to that leverage?
And I think in this anonymous talk, there was some talk about like they can't even really move the needle, right? Like no matter how much
Right.
first get, basically what you're saying. Which brings me, do you think CalPERS, right, when they was it CalPERS who famously ditched the tail
Yep.
hedges? Like was maybe that wasn't because there was a line item, it was just someone there was like, hey, this doesn't even make sense. Like even if we pay out on this, it's not going to move the needle.
Yeah, it could be that because we weren't privy to those conversations, so it's easy to villainize them and villainize that CIO when it happened. The only thing, the
Yeah.
counter argument to that would be is he only cut one of his tail risk programs. They had two, so he cut one of them and kept the other one. So
Mhm.
who knows what those conversations were necessarily like. So they actually, people do forget or don't know, they actually made some money on a tail risk program with a manager that we know very well. So that's part of that story too. Once again, I don't speculate what happens in those private rooms, other than it's a Rorschach blot for everybody to put their hopes and dreams on. One of the other things I want to bring up with pensions that I've seen lately too, as this is now you're starting to see this new nomenclature, though, the total portfolio approach. And once again, it's like meet the new boss, same as the old boss. Like all of this
Yeah.
nomenclature verbiage changes as as we went from, tech companies where it's like fan mag to like they're always the acronyms are constantly changing. But the newest one that you're going to hear a lot from pensions and endowments, the total portfolio approach, to me, it still seems the same as the Yale Swenson model. It's just they don't have buckets anymore, right? They're still doing broad diversification across asset classes, et cetera, but they don't have a hard and fast rule of like this has to fit inside this bucket, which was always actually a big problem talking to some of those institutions. If you ran a different strategy and they didn't know which bucket to put it in, they'd automatically kick it out. So it's nice that they're not, I guess, strictly adhering to those buckets, but I can see the portfolios essentially look the same as the Swenson model. But I guess at the fringes, they're allowed to move the needle here or there without having to convince their board that there's any sort of portfolio drift outside of the specific asset classes. But maybe I'm missing something on the total portfolio approach, but it seemed pretty much similar to what they've been doing before. Just they're kind of removing some of their own shackles, I guess, a little bit, but still kind of same thing.
And there was some interesting talk at the symposium round of like using a um like a 80/20, call it, stock bond, just for not that's an actual allocation. Like to what you're saying, okay, we have the classic structure, but that's just to give us a risk. That's what we want our risk profile to look like. So that's where our risk assets are, even though underneath there, we're just going here, there, everywhere, total portfolio approach. But we can, and that's basically like give me equity risk with, or lower than equity risk with equity-like returns. The last one was with one of our favorites, Roxton. I wrote down in my notes here, has Roxton ever been in a room where everyone in that room understood what he's talking about? Because he just goes quickly, he speaks fast, and he's as smart as it gets. So, thoughts on Roxton as I pull up my other notes here?
I was thinking about well, one other thing is like when you're referencing something you want to say about the previous talk, and then also Roxanne also had another panelist on this, and Corey was moderating. But for obvious reasons, some of these institutions don't want it out there publicly necessarily what their managers were talking about, which is another reason to be in these rooms, to go to these events like this, and that way,
Yeah.
whether it's Chatham House rules or people just don't want to talk about it at all. This gives you insights to be in those rooms where people are at least allowed, talk more freely than they normally would. So you can probably get some better insights and then do those, like I said, those follow-up questions. Roxton, obviously, I could listen to Roxton all day. We think very like-mindedly. I appreciate how fast he talks, seeing how, as you know, I listen to things at 2 to 3x speed. So Roxton's like tailor built for me. Loved the podcast he's always done with Corey in the past. Um, and he was talking about orthogonal return streams instead of necessarily uncorrelated. And so man after my own heart, he was talking about correlations. It's hard to figure those out because obviously correlations are conditional, especially during liquidity events. So therefore you shouldn't maybe rely on correlations as much. But if you have orthogonal strategies, which is probably just a fancy way of saying uncorrelated, but you think through the return driver of that orthogonal strategy, it's more like combining those orthogonal strategy. But at the same time, man after my own heart doesn't necessarily believe in alpha. And he said even those orthogonal strategies are just undiscovered beta. So
Mm.
eventually we'll write those down as beta. I mean, you can argue that basically, that even Warren Buffett was just a factor investor, right? He used the low vol factor and he leveraged it up 1.6 times. But discovering that before it was a beta and running it for 80 years is a superpower. So I think we can get maybe too much into semantics. Is it alpha or beta, or is it just undiscovered beta? Doesn't really matter. Is you just want to try to put together a portfolio of as many orthogonal return streams as you can.
Which at the cocktail hour, the aforementioned Jim Carroll was doing, he's basically saying an orthogonal is a
Yeah.
90-degree edge, right? He's like, wait, if I have
Yeah.
this one and this one and this one and
Yeah.
this one and this one, don't I just have a circle? He's like, do I have nothing? Which I know you and Corey have debated in the past, right? If you have, what's the point of diminishing returns? If you have so many orthogonal, non-correlated return streams, do you basically just get the risk-free rate? And maybe that's not a bad thing because if you lever it up and you get,
Right. Well, as was talked about on many of these panels, it's probably the risk-free rate plus, right? So hopefully you're getting plus 2 to 300 bips, but then you know exactly what you are over that risk-free rate, and then you can attach any sort of leverage or capital efficiency to it. And this is essentially what the pod shops do, right? If you can consistently produce, 2 to 300 bips over the risk-free rate, well, then you can use swaps at banks or you can use managed futures to use better capital efficiency to toggle that to kind of whatever return profile you want. And then it can be arguable too if they're truly orthogonal or uncorrelated. You could also harvest a little bit of rebalancing premium whether that's over calendar rebalancing or threshold rebalancing, that will probably add some bips, and it can be arguable how many. And so that's what you're doing, right? And I think that's just a much more rational and reasonable way to look at it. Is you're just trying to get a couple hundred bips over that risk-free rate, which will be probably a couple hundred bips over inflation, and that's what's really going to protect your portfolio over time. And then by including as many orthogonal or uncorrelated strategies as you can, you'll hopefully increase that Sharpe ratio, increase that MAR ratio, reduce those drawdowns and those downside variants as much as you can, so you can hold it during times when everybody else is panicking. But I think that's a pretty resilient or simplistic way to look at it that makes a lot of sense to me.
Um, Two other things here. Roxton was going super deep on plan dynamics in the beginning of like, well, this investment won't line up with that plan sponsor's views on this, and this is how they get their bonuses. And so it's like for sure three-dimensional chess at that level of tens of hundreds of billions of dollar pensions and endowments, and who are the stakeholders, who's getting paid what to do what. Which is why I think that's when I wrote down of like nobody in here maybe knows or cares into that detail, but he just knows it off the top of his head. He was just riffing on it. And then two, they echoed one of my favorite concepts, right? Of like, it's not just enough to have statistical non-correlation. You need to have what I call fundamental non-correlation, which I
Right.
can't remember what their term was, but orthogonal, like these need to be doing different things. Like you can end up with a portfolio of all trend followers that have non-correlation to each other. Probably not trend followers, but maybe long short equity managers that have non-correlation to each other. But when things go bad, those correlations are more likely to go to one. So, as you said, nice to be a echo chamber and hear what I want to hear from them.
Yeah, and I'm sure maybe we'll get to it next, but after that we have the happy hour too. And so Rox and I were able to pull each other aside and go a little bit deeper dive into even figuring out those orthogonal strategies, or like how do you look at that matrix or orthogonal strategies? Because shout out to Adam Butler, I brought up the three body problem that he loves so much. Is like as
Yes.
soon as you have multiple orthogonal strategies, how orthogonal are they to each other, right? Now you get a whole different matrix of or morass of problems that you're running into. And we talked about different ways of ranking those off of, information theory, entropy, copulas, but at the end of the day, you're still using past performance to predict future results. And it's still kind of finger in the air. And you're just trying to use probabilities and statistics to build the best portfolio you can. And then, like you said, you need this fundamental overlay of what's the general return driver in, basically risk on, risk off, which is, how the way you think about it is like you have offense or defense or the four quadrant model. Outside of that, they're probably going to be highly correlative to each other within that framework. So maybe a max you can get is two, either offense, defense, correlated, uncorrelated, or maybe four, given the four global macro quadrants at best.
And then I think it was Roxton noticing he was just going deep of like, yeah, and we had 100 million in profits from such and such tail hedge, but the bank said no, we're calling
Yeah.
force majeure on COVID and we're not paying this out. And he was like, what the? So it's just like literally you can't learn those lessons unless you're in the arena.
Yeah, and well, it's gotten better and it hasn't. So I was having this discussion actually after Roxanne mentioned that. Is another friend of mine in 2008, he made billions of dollars for clients in the tail risk hedging, right? But it was all counterparty risk across investment banks. And he was able to get his money to his clients, but it took upwards of 18 months for the negotiation and lawyers involved and everybody to get that settlement. So it's kind of like, to me, it's like FDIC insurance. Yes, say you got 100 grand at the bank, it's FDIC insured. But if the bank goes under and those assets get frozen, how long is it going to take for you to get them back? So once again,
Yeah.
time becomes your absorbing barrier. And maybe I think people forget about that a lot. And luckily, like, we've talked about these counterparty is does these days with, cash sweeps on a daily basis. So that's gotten a lot better. But I don't, I do worry that they'll figure out a way to screw the client in the end in the future too. So there'll always be a novel way for them to make sure they don't pay out in any sort of timely manner. And quite frankly, even, you and I argue about this, but the listed exchanges, could have some sort of cataclysmic event that blows out through all of the collateral and everything. But those are too big to fail. But the question is, if something does happen, how long does it take for the government to backstop that, and how long until clients are made whole? So I mean, these are all things to think about because, time can be one of your biggest absorbing barriers depending on what your liabilities are.
And then I think I asked a question on every panel. So I didn't
Yeah.
disappoint on this last one, but basically said, um, which I want to get back to one of my other questions as we wrap up. But in this one, I said, hey, all day we've been talking about adding these non-correlated strategies, right? Alpha matters, it helps, blah, blah, blah. Like, but really what's happening outside of everyone in this room and everyone into portable alpha and return stacking, what's happening in the whole rest of the world is people are adding correlated strategies. They're
Right.
doing option overlays and covered call strategies and buffered notes and stuff, which are basically just using the same equity index derivatives. So I can't remember my exact question, but I was like, what are your thoughts? Is that a problem? Is that a type of portable alpha? And Roxton was like, I don't want to be controversial. And then went into a 5 minute tirade on how buffers are BS, just do less stocks. What are you doing?
Right.
They're not going to protect you in the downside, like yada, yada, yada. So that was refreshing. You got any quick thoughts on that?
Yeah, I think even the guys at Resolve for Return Stacked, it was years ago. I think they wrote a great paper, an essay on it, or they've talked about it as well. It's like just regress a buffered note to 60% exposure to equities. I mean, that's or any sort of call overriding, et cetera. Like those kinds of things. That's all it is holding less equities, which is essentially what 60/40 is, right? The almost 90+% of your risk is in the equity bucket. So I think that's what sometimes and maybe we run afoul of this too is a lot of times maybe you don't have to use derivatives or options or more complex strategies to instantiate the trade you're looking for in a very simplistic manner. And sometimes Occam's razor is the best, and maybe it's just holding less equities.
Yeah, I've our old pal Ben Eifert used to say that a lot, which I've actually incorporated in my own trading. I used to sell a lot of covered calls against some of my positions. It's like, no, just if you're worried about the exposure, just sell some of it. Sell 10% of it, sell 15% of it, then get back in. All right, wrap up somewhere on my many pages here.
I'll jump while you're trying to find. I'll jump into one I was maybe even thinking more again today is Corey's always been so good with me with thinking about this is especially because they deal with a lot of RIAs and we work with some RIAs, but it's not necessarily our wheelhouse, is providing them with that client 60/40 portfolio, but allowing them to return stack these hopefully uncorrelated strategies on top of it. But more importantly, he's like highlighting to me how important it is that it's long short portfolios all the way down is what he's always said is like if they
Mm.
have to sell some of their stocks and bonds to buy this, it comes incredibly difficult for the client, and that makes the pitch even harder. So you just replace their stocks and bonds and offer a capital efficient way to get these uncorrelated strategies. And so I'm thinking about it even now, like, that's when people keeping up with the Joneses, et cetera. It's like it's a spoonful of sugar helps the medicine go down. Maybe you have to give them that 60/40, or maybe now it's 80/20. Give them that portfolio, but then use capital efficiency to stack some uncorrelated strategies or orthogonal strategies on top of it. And we're seeing it even now, maybe I think you want to maybe we'll talk about gold a little bit, but once again, is like if you want to add gold to the portfolio, it's a nice overlay, not necessarily having people sell off some of their stocks and bonds, especially after a run up.
So my thought was kind of echoing your thoughts. I wrote down big takeaway. Nobody wants to sell equities. So that was one of my earlier questions. And then one of the panels, do you think do you have any math? I think that was the first panel because he had all the math and charts. Do you have any math that's showing how much this is added to the equity bid, so to speak? Right? If portable alpha is growing, as you just said, those clients don't want to sell down the equities, so they don't
Right.
have to sell it down to buy the alts. Is that driving equities even higher? Is that a self-fulfilling proposition?
Well, like I think I'll use one of your other arguments against you. Like when you've looked at the size of commodity trend followers, or specifically, yeah, the CTA space is like whatever number they threw out there, like half of that number historically has been like Bridgewater. So
Yeah.
like that number is just in the low hundreds of billions. What do you say? Like maybe
Yeah, that
200
are
billion
doing
max right
portable
now?
alpha. Yeah.
Well, and that's the whole CTA universe. Then the ones that are overlaying portable alpha and giving people the stocks and bonds or giving them MSCI World, it's even smaller than that. And so, maybe we get in that echo chamber of that room, but we don't realize how small we are on the periphery. But
Yeah.
I think you're right. At size, it does add to that bid, and it's almost similar to Mike Green's passive theory. Is like it's a constant inflow to be buying more equities. That does affect the markets a little bit, but I think right now we're at the size where it's not even near being consequential.
But it sort of raised my alarm bells of like
Right.
if nobody wants to sell equities, is that a good or a bad thing? It seems like a bad thing. It seems like a danger because then everyone will want to sell them at the same time, or no? Or are we creating a whole new type of investor of like, no, you never need to sell equities. It's fine.
Well, it seems to be the zeitgeist of the market right now, so we'll
Yeah.
see how long it lasts.
All right. That's all I got on that. While we have you, any thoughts of what's going on in the world? Gold at new all-time highs. Um,
Well, it's
Trend
actually been scaring me how
bouncing back a
much.
little bit.
Yeah, how many text messages, et cetera, I'm getting about gold. Which I don't know if that's the old shoe shine boy or the cab driver. I'm talking about
Yeah.
gold. But even I was at a private event a few weeks back, and a guy was talking about he got all of his kids to, they're in their early 20s, starting out their journeys in their working life, and he was getting them to put all their savings in gold, 100% gold. I'm like, and he was
What?
bragging about like, it's 2x than the last year for them and everything. I go, yeah, wait until they have their first 30, 40, 50% drawdown in gold, which you've seen a million times, is like then they're maybe never going to invest in gold again because they got burned on their savings side. So I just thought, once again, it's just like 100% in gold. Like that's an awfully aggressive strategy. Obviously, we're thinking about portfolio diversification, especially against what I would consider your stable coin or your savings. Maybe that's not the best scenario, but like it is concerning. But at the same time, those that are calling for their top in gold, and you've seen this many times, it can run on a lot longer from here.
Yeah. And I know you love to play macro tourist, but
Yeah.
joking aside. Well, the reason gold's going up is because
Yep.
XYZ. Um, no, I've stated before I've been long or wrong, not long,
Yep.
wrong on gold for years and years and years. I don't get it. Right? It's just the classic, it's Bitcoin version 1.0. It's only going up because people think it should go up.
Yeah. Maybe, I mean,
But
that's what
I've kind of come
go ahead.
around to who cares then?
Yeah.
If that's the game, who cares? Get in the game.
It's like placebo effect. Like I argued in this room a few weeks ago, I was like, is gold just a Lindy effect? Like it's just been around and people thought it was money, had some moneyness for so long, and that's what you're betting on, right? What's worked
Yeah.
for 2,000 years is going to continue to work, and we don't know if Bitcoin becomes the new digital gold. But once again, it's like who cares? It's placebo effect, and if the psychology of the masses are to go to gold, then maybe that is it. But then, like you're saying, what has given this recent price rise? I don't like. The other thing is if you study gold for long periods of time, it maintains your purchase power parity over the centuries. But any year or multiple years or decades, it can disappoint you. And it has that lead lag effect, like the bullwhip effects, like we have with supply chains that we learned to quite a bit about during COVID. And so that's the other thing. It could be, they're like gold hasn't, allegedly, if there's all this inflation from COVID into 22, 23, they were like, where was gold? And then now it's jumping out from behind the curtain. Maybe that's a lagging effect. I don't know, because once again, you're basically creating horoscopes and where you can, match any of your Rorschach plot over that and use any sort of global macro narrative you want.
I used to read my horoscope when there was newspapers. I miss that, right?
That's how I trade, right? It's just whatever.
The any other thoughts while we have you? Anything,
No, I think in general,
any
I think,
splinters in your mind
yeah, yeah, a couple of things. One, even
besides all the
the
usual? Yeah.
yeah, the week before was that private event. All the talk was about AI more so than even gold, and it just reminds me that in real life is going to become more and more valuable. And there is something about being in the room with a lot of our friends, a lot of new faces, and just being
Mm.
able to have those little conversations, put a face with a name, even if it's only 5 minutes here or there. It's incredibly more valuable to make those connections in real life. And I think that's going to become more and more valuable over time. And we'll see where these guys take it. If you're listening to Rodrigo, the next one's going to be 5,000 people. If you
Exactly.
listen to
Yeah.
Corey, the next one's going to be a tight 50 and behind a rigorous process. So we'll see where these guys take it from here. But obviously, it was great for us, but obviously a lot of confirmation bias and a lot of like-minded thinking.
But I'm trying to gonna put a positive spin on confirmation bias because that's as you're saying, like in today's world, how do I know
We're
all
the
these
fringe. Yeah.
podcasts, all these blog posts on all this isn't just AI BS? Like it's good to hear people who are actually doing this, who actually saved this pension, who are actually doing it in institutional settings, who are doing it in RA settings. Like, hey, we're actually doing this. It's giving people the outcomes they want. So yeah, long live humans. I'm watching the Alien Earth series right now on Hulu. It's insane. It's great. Like ignore the alien creature stuff, and there's this whole subplot about like in the future it's going to be humans, cyborgs, which are humans with like a knife for a hand or whatever, like enhancements, and hybrids, which are like they put a human psyche into a synthetic body, and then full on like androids, full on robots. And that would be the battle. So we fully digress, but I kind of like that. I can see the world going that way.
Well, like we said, we always talk about the best hedge fund managers now are what you can, and that nomenclature be like a cyborg hybrid, right? We use technology as much as we can, but then you still need the creativity of the human element. And maybe one day that'll get computed away too, but we'll see. For the time being, it's good to be able to use both.
All right, man. Good talking to you. We'll see you shortly. Talk to you shortly. Don't go changing. All that good stuff.
Thanks.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.